Hello there. Let me teach you about how you can make some money from your savings. From your hard earned money, you can earn more money very cheaply. Okay? So, about I've been investing since 2017. Actually, I started in 2012, but that was only for like a couple of months and then I quit. And then I started really investing permanently since 2017. I learned some shit, and let me share with you how you can easily make money and what I do today. So, this is our McDonald's. We got McFlurry, orange juice, iced tea, French fries, and we got the double play properties to try and win a prize on the Monopoly game. Okay? Now, if you want to play Monopoly in real life, take a look at this. This is my Questrade account. Take a look at this number right here. Total P&L, total profit and loss, plus $13,000. Right? Now I just withdrew $800. So this is actually plus $14,000. $14,000 I made. Today's profit, it says $2,600, but that's a lie. Oh, that's open profit, $2,600. So my investments right now are worth $2,600 in profit, and today I made $120. And in total I made $14,000. Okay? So that is with my new strategy since about 3 or 4 years. 3 or 4 years I've been on this strategy, which made me $14,000. Maybe my old strategy made me a couple of thousand, but I didn't have a lot of money with my old strategy. I was only investing with $1,500, so I don't think I made that much money. But my old strategy was like, I have a subscription to a stock website, like a news website, and they come out with big bangers, and I double check the big banger. If I like it, I buy the big banger, and I follow it. I make 25%, 20%, 15%, or whatever, and I sell the big banger, and I just repeat it like that. And I made good money. I made 50% one year, 70% another year, but like I said, it was only on a $1,500 account. So I only made like a couple of $100, and here's how you start. If you have a bank, right? If you have a bank, there is an option for personal investing in your bank. And what you do is you go to the bank and you ask them, or you do it online. I think you can do it online nowadays, but you used to have to go to the bank to sign the forms. And you open a registered account. What's a registered account? Registered account means it's used for savings. It's registered with the government. Everywhere you go, even if you go to Robinhood, Wealthsimple, Questrade, wherever you go that's not a bank and you want to invest with them instead, you still need to open a registered account with the government. So you open a registered account. That means all your trades are going to be documented. How much money you make, how much money you lose. And it's going to be used for tax filing purposes. So you're going to need to save money to pay tax. Or if you lose money, you're going to be able to collect some of that money back through tax if you lose money or whatever. So the thing is, why is it called it's called a margin account, registered margin. And why is it called a margin account? Because the margin means how much you are borrowing. So this is important because say you have $5,000 in savings. Now you want to invest it in a safe investment. So you're $5,000. So you're $5,000. Safe investment, say 15%. $5,000. That makes you about like what, $700 or something like that. Okay. Now with the margin, that means they will judge how safe your investment is. And they will lend you money for a certain amount of time frame and limits and whatever conditions, so that you can use their leveraged money to invest in your account. So for example, you have $5,000. You can get a margin. Oh shit, no, I fucked it up. Because I learned a hard truth. Yeah, it used to be a good idea, but I don't think it is. Damn. What it was like, you have $5,000 and you can borrow $15,000 depending on how your safe investment is. So you borrow 15,000 and you have 5,000 in collateral. So you can, and then they charge you interest. So they charge I believe it used to be a small amount of interest. So like you have $1,500 and they charge you 3% interest per month, per year, or whatever. And you're paying back 3% per year, but your investment is going up 15% per year. And you are making money on that $15,000. Unfortunately, this is, I believe, too good to be true, because when I accidentally incorporated this rule, what happened was I borrowed like 20,000 or something by accident, because I thought it was my savings account, but it was my margin account, and I borrowed 20,000, and within 2 months I paid like a fuck ton of money in fees. It's like a credit card. You can borrow the money, but there's no way you can invest it and earn enough money as to how much money you're going to be paying them in fees, in interest. They charge you a fuck ton of interest on that. So it's like, it's used for just super high risky shit. Like you get a tip on insider trading that some stock is going to go up 100%. So you're willing to pay 30% interest in 3 months to make 100%. So you think you're going to make 100%, you borrow $40,000, you pay 30% interest on that, and with your 40,000 you make 100%. So, but it's for short term only, because in the long term it's like a credit card. You're literally paying like 11% interest per month. So you got to make more than 11% return on your stock per month. So if you know stock's going to go up 100%, then you can leverage $40,000, $50,000, right? So the other option is to get a tax-free savings account with your government. So what that is, it's tax-free. So normally every single dollar you make is taxed at 50% of the maximum tax rate. So it's called capital gains tax. However, when you lose money, you can also recover some of that in capital losses. But you got to keep track of it and record it throughout the year. So you make $20,000, you got to pay tax 50% on that 20,000. But with the tax-free savings account, that means you don't get margin, you don't get to borrow money, but you get to anything you make with investing, you get taxed 0%. So you get to keep everything you make. However, you also don't get to record your losses. So if you lose money, you're not getting paid back for that. So it's your own money. It's like a debit account, debit account. It's all your money. You lose it. You win it. And there's a limit to how much money you can throw into this account. In Canada, it's like almost $100,000. It's like $75,000 if you're over the age of 18. So $75,000, and you get taxed at 0%, and you can grow it to however much you want. But if you withdraw money, you can't put that money back in until the next year. So if you're at 75,000 and you withdraw 5,000, you can't put in a new 5,000 until the next year. So those are the accounts. You got to open an account with the government, with your bank, or with a private investment firm. And my advice to you is to choose one that's trustworthy. The banks are always trustworthy. Now, why did I choose Questrade? Because at the time, how long is it? 10 years ago, 15 years ago, the banks were charging $30 per trade. And Questrade was charging $5 per trade. So naturally, I started with the bank in 2012, and you know what? 5 trades and you're paying $150, and I only have like $5,000 in the account. 5 trades, I'm paying $150. Switch to Questrade, 5 trades, I'm paying $30. So that's why I went with Questrade over a bank. After about 10-15 years, the banks started catching up to these private investment companies, and they were matching them. So Questrade was $5 a trade, and now the banks were $7 a trade. Now you should not settle for anything less than $0 per trade, because let me tell you, fees add up. Okay. You don't think they do. Say you're investing $1,000, right? You put in $1,000 of a stock you like, and you pay $5 on a trade. When you sell it, you also got to pay $5. So that's $10. So that's already 1%. $10 to $1,000 is 1%. So you got to make 1% just to buy it and sell it. Say you buy it and sell it twice. Now that's 2%. Say you own 5 stocks. That is one, and you buy and sell them once or twice. That is 1 to 2% on every single stock. So say you got $5,000 and you're going to buy 5 stocks, each worth $1,000. That is $25 to buy all 5. Another $25 to sell all 5. So $50 on your $5,000 account just to trade them one time. Now, in 12 months, that's a hefty amount of time. In 12 months, you're going to make probably not 5 trades, not 10 trades to buy 5 times and sell 5 times, but you're probably going to make around 100 trades. You're probably going to make around 100 trades. You're going to buy stuff, you're going to sell in 2 months, you're going to sell in 2 weeks, you're going to reorganize, you're going to redistribute, you're going to buy new opportunities, you're going to sell stuff, you're going to hold stuff. You're probably going to make 100 to 120 trades per year. And if you're paying $5 per trade, because you're buying and selling as well, so you're making 60 buys and 60 sells. That is $500 to $600 a year. That is $600 per year just on fees at only $5 per trade. $5 per trade. So you have a $5,000 account and you're paying $500. That's 10%. You have to make 10% per year just to break even on your fees. And making 10% is hard. 10% is a good return. But on a $5,000 account and you're paying $5 per trade, you need to make 10%. That's why I made zero money when I started in 2017. I made 50% and 70% returns on my, news hype stocks. And I made 70%, but I paid all on $1,000 account, $1,000 account. All of it went to fees. And then I started day trading. And day trading was another fucking mess. With day trading, what you're doing is you're making trades within minutes. So you're watching a mega stock, super crazy ass stock in one day. And you are buying on margin, so you're using the margin, but you're also selling it within a couple of minutes to an hour. So you're not paying any interest on the margin because interest is calculated at the end of the month. But because you're holding it for less than 1 day, you are paying no interest. So what you would do is you would buy with a $10,000 account, you will buy $50,000 worth of a stock. Hopefully it goes up 0.5% within an hour, 0.5%. And then you sell that $50,000 worth of margin and you will make $200, $300, $400. So each trade, you are trying to make $200, $300, $400. And at the end of the day, you want to make between $200 and $500. So it's like a job. You're not going to make $1 million in 1 day or in 1 year. You're going to try and produce a steady income of $200, $300, $400, or $500 a day. You put $10,000 in your account. Every trade you margin up to $50,000 and you try and make 0.5% on each trade using your graphs and your charts and your readings and your indicators and your judgment to make $300-$400 per trade per day. And I was able to achieve positive results. However, with this method, even the goddamn fees killed me. Why? Because with $50,000, you're not buying and selling in one go. You're putting in 10,000, then another 10,000, then another 10,000, then another 10,000, then another 10,000. And then if the trade moves in your direction, you're the way you wanted it to go, up or down, then you scale out. So you sell 10,000, 10,000, 10,000, 10,000, 10,000. So this way you're making 10 trades per stock. So 10 trades, that's $50. That's $50. So if you make $50 on one trade and you're trying to make 5 trades per day and you want to make $200 per day and you're making 50 trades per day and you're paying $200 in fees, that's why I was a loser or a net even, because I was making my $200 per day, but then I was paying $200 per day in fees. So I did day trading for a couple of months, maybe a couple of years, and I couldn't find success in it because the fees killed me. Now, today, check this out. $0 commission trading is here. And this is a major this is my Quest trade. This is a major broker. Banks also are offering $0 commission trades, I believe. Maybe not. So I can do day trading and make a profit, make $50 a day, $200 a day, because I am paying $0 in fees. I can invest with a $1,000 account and pay $0 in fees. And that's important. Why? Because you are trading 100 to 200 trades a year. Or if you're day trading, you're trading 100 trades per day. So fees really add up. Unless you are trading with $1 million account and you don't care about these $5 fees, you want to find $0 fees because they exist. This is a mega corporation with very trustworthy, affiliated by the government, and they are offering $0 fees. And it's true. I've been using it for $0. So make sure you find a brokerage firm. These are called brokerage firms with $0 commission. Now, so you open a registered account with the government, either a margin or a tax-free savings. What next? What's my strategy? So you use a free, you need charts. So the chart I use is TradingView. No, fuck off. I don't care. So the chart I use is TradingView. I used to pay for the premium, which was $500, but you can get everything you see here for free. So you have your little watch list on the side, and you color code them, which they won't let you color code if it's free version. You need to upgrade for that, but don't color code them. Who cares? And you got your watch list. You click on one of them, brings up the chart. I have it as a bar chart. So these are bars which show how the trading happened each day or each week. There's W for week. And I have this line, which is the moving average. It is the 9 and the 20. Where is the 20? What does this tell me? It's not letting me plot the 20. Okay, so I have the one moving average and my bar chart and volume. Okay? So what you do is you pick a stock that you like. You go down here, you read this, you look at the revenue and the earnings. So look at revenue and earnings, and this yellow line is the margin. So that's profit margin. So how much money they make on each dollar of revenue. So expenses and costs over profit. And you have your analyst forecast. So you look at revenue, earnings, and then you look at the news. You can go to the company website, read the investment presentations. So these are presentations that come out once every quarter. Every quarter they come out with a report, and you read that. You Google news about them. And one method that works is to find hype fucking stocks. So hype stocks. So remember when marijuana was legalized in Canada? You needed to get on that within a year. You don't got to spot it right away, but get on it soon. Bitcoin was hyped. You need to ride that too. Electric vehicles, here's Tesla, was hyped. Look at this. Now it's not very hyped. This is since 2001. Not that hype. But before 2001, look what happened. I remember my friend and I were talking about it in 2018. 2020, that's when the hype started. That's you get in, and now the hype has died down for electric vehicles. Maybe it's starting again in Tesla because of the politics. What's the new hype? It's AI. So you go down to NVIDIA. This is the hype around AI. Over here was pretty normal going up, going down. And then around 2020, 2023, 2024, all the hype started and it shot up. So industry leaders like NVIDIA, Tesla, electric vehicles, marijuana, whatever's happening in, this is the US market, but also around the world. It could be a commodity, it could be gold, it could be, metals, it could be chips. NVIDIA is also chips. So AI caused chips to go up. Microprocessor chips. It could be Facebook, it could be Netflix. I have all the biggest guys here. So Google, Microsoft, Apple, Disney, Netflix, Uber, right? So now what I do is I stick to 1 to 2 of those. So whatever's hyping. So I used to get Disney. I used to get Tesla, whatever, fucking, Uber, Netflix, Facebook, Google, Microsoft, Amazon, McDonald's, Coca-Cola, oil, random ass shit. And you stick to a couple of those that you can follow, and you're trying to make 20 to 50% in those, 20 to 50%. And the other one that's nice is Bitcoin. But it's hard to buy Bitcoin with a brokerage account. You need to buy the Bitcoin fund, or you need to open a separate account for cryptocurrency, which is always shady. They always do shady ass shit. So try and find the Bitcoin fund. If it's possible and you know how to invest in Bitcoin, that might not be, but only like 5 to 10% of your investment funds should be used for Bitcoin. Now, what's the strategy I do? Simple. That earned me $14,000 in a couple of years. It's this. Here's SPX. What is this? This is SPX. This is the market, okay? This is all the stocks on the stock market averaged out. As you can see, they go up and down, but in the long run, they go up 15 to 20% per year when they don't go down. So what that means is you are guaranteed to make money in the long run. There are a couple of them. This is the S&P 500. Then you have the NASDAQ. Guaranteed to make money in the long run. Then you have your small stock collection of all the small stocks on the market, collection of all the medium stocks on the market, and then you have the weighted. So what this does is it tracks the average of the stock market, guaranteed to make money. However, when it goes up twice as much, and when it goes down twice as much. So these are called weighted or leveraged. So you are guaranteed to make money in the long run as long as you don't need to access your funds right away and you put your money away for 2 to 3 years. You are guaranteed to make money, guaranteed to make easy fucking passive money. So you buy some S&P 500 ETF, electronically traded fund. It's a fund. You buy one for the S&P 500, one for the NASDAQ, and one weighted 2 times that much. So twice as much, and the NASDAQ and the S&P 500. You buy 3 ETFs, and then you buy one hype stock and one Bitcoin fund. So you buy 3 ETFs, guaranteed to make money. Then you buy Nvidia or Microsoft or Amazon or Google or Tesla, whatever is hyping, or Bitcoin, you buy a bit of that. So you own these only 5 stocks and you don't need to touch it. You don't need to worry about crashes because when a crash happens, it affects the dumbass who has all his money in stocks. No matter what stock you have, when a crash happens and you have your money in stocks, when the market goes down 10%, you are going down 40%. When the market crashes like a big ass crash like COVID or epidemic or dot-com bubble or housing crisis or depression, recession, and the market goes down 25%, your stocks are going down 80%. So if you have all your money in ETFs, guaranteed to make money in the long run, and the market crashes 1 year, you are only losing in your account maximum of 20%. Maximum of 20%. You can live with that. And knowing that in the long run, just in 3 years' time, 2 years' time, 1 year time, you will be back in the positive. You will be back in the positive. I made $14,000. I went through some more COVID crashes. I went through election crashes. I went through tariff trade war crashes. This is the American stock market. The American stock market. I'm not investing in the Canadian. This is all American ETFs. I went through Trump trade war. I went through election. I went through COVID epidemic. No matter what the fuck hit. I went through the recession. I went through inflation. No matter what happened, I recovered. I did not touch the money. I let it sit there. I recovered. And I made $14,000 on a $20,000 account. Nearly 100% in 3 to 4 years. In 3 to 4 years. And it's easy fucking money. The market crashes. You don't lose a lot. You hold it over the long run. You guaranteed to win. You are making easily 20% per year. No fees. No middleman. No banking accountants. No talking to somebody on the phone, no calling somebody, trying to get a connection, trying to get a meeting, get an appointment. You just buy 3 ETFs, 1 hype stock, and you sit down and chill out, and you make 20% per year. Tax-free savings account. Also, when the market does crash, what did we say? All the stocks go down 80%. 80%. So you take a little bit of money out of your ETF and you buy the biggest names that have crashed the most. So it is pure gold. It is pure gold. COVID, tariffs, recession, trade war. Something happens and those stocks crash 50%. Google, Apple, Microsoft, Facebook, Nvidia, whatever, Coca-Cola, Nike, Disney, the biggest guys, Netflix, they crash 50%, they're guaranteed to recover at least 50%, at least get back to where they were within a year. Or if they've crashed 80%, you get in there. So you buy these big blue chip stocks that have crashed and you sprinkle some money in there, easy 50 to 100%. If it crashed 50% and it recovers 50%, that is a 100% gain for you. That's not a 50% gain for you. It crashed 50% and then you get in and then it goes back to where it was. That's a 100% gain for you. So with the hype stock, you're getting 50 to 100%. And with a crash, you are gaining 50 to 100%. And then you have your ETFs, your indexes, and you're gaining 20% per year. That's my strategy. I've been sitting on my ass. I used to check the markets every day. Who's winning? Who's losing? Where's the news? Where's my account? Where's my fees? What's my profit? What's my loss? What's my risk? Always sweating. Now my money is in there sitting, making 20% per year. When there's a crash, I can check it. When there's a hype stock, I can check it. When I get some profits and I need money for spending, I can withdraw some money. But it is easy fucking money. Private brokerage account with your bank, with a private company, no fees, open an account, registered with the government, savings account, margin account, and free money. Easy as shit. Stay classy.